Genting Plantations, Berhad Internal Model Estate Initiative and Certification. The concept of uniformity and standardization, hence be recognized as Genting Plantation Model Estate, was mooted by President, Chief and Chief Operating Officer in 2008. This is to encourage planters to accept challenges to pursue excellency rather than just routinely managing of an estate.
Sarawak Oil Palms Berhad, SOP, was set up in 1968 as a joint effort between the Sarawak State Government and Commonwealth Development Corporation, CDC, to pioneer the commercial planting of oil palm in Sarawak.
In all business sector, it is important to know the company's performance by analyzing a company financial position through ratio analysis. Genting Plantations Berhad and Sarawak Oil Palm Berhad are both prominent Malaysia companies involved in the palm oil industry. How is their company performing, and which company performed the best in the world? Genting Plantations Berhad was incorporated as a private limited company on 29 September 1977. It commenced operation in 1980 as the plantation arm of the Genting Group, founded by the late Tan Sri Lim Gotong, and in 1982 it gained a listing of Bursa Malaysia, then known as the Kuala Lumpur Stock Exchange. Genting Plantation has successfully transformed itself from a modest, predominantly rubber-based enterprise into one of the regional leading oil palm plantation group. Starting with a 13,700 hectare in West Malaysia in 1980, Genting Plantation land bank has increased by leaps and bounds to about Starting with a 13,700 hectare in West Malaysia in 1918, Genting Plantation land bank has increased by leaps and bounds to about 243,300 hectares, currently spread over Malaysia and in Sarawak Oil Palm Berhad is involved primarily in the cultivation of oil palms and the operation of palm oil mills. Sarawak Oil Palm Berhad was listed on the Bursa Malaysia in August 1991. In June 1995, Xingyang Plantations And Berhad SY Group bought over CDC entire share in SOPB of 25%. Presently, SY Group together with Pelita Holdings Sdn Berhad, an investment arm of the Sarawak State Government involving in property, urban development and plantation, remains as the two substantial shareholders of Sarawak Oil Palm Berhad with shareholding of approximately 35% and 28% respectively. Sarawak Palm Oil Berhad Group has since expanded its land bank to over 122 hectares with 88,000 hectares planted with oil palm tree in Sarawak. Oil palm plantation and the production of the crude palm oil and palm kernels will continue to remain as the sole core business of Sarawak Oil Palm Berhad Group. In conclusion, both companies have their pros and cons when considering overall financial health by combined liquidity, leverage, and profitability. Sarawak Oil Palm Berhad appears slightly stronger due to its lower financial risk and superior efficiency despite having weaker profitability. Meanwhile, although Genting Plantations Berhad.
Hi, I'm SHAHRIZA from Yusuf. Today, I'm going to explain the trend analysis of Genting Plantations Berhad for past 3 years from year 2021 until 2023. Firstly, we look in Genting Plantations Berhad liquidity ratio, which is current ratio. The ratio shows that 2021 had the best performance with a value of 2.98 times, indicating strong financial health in terms of paying off short-term debt. For 2022, the ratio dropped but still reflects a relative strong position as ample liquidity. However, for the current year, 2023, the downward trend appears to continue. Even though the ratio is 1.88 and still above 1, it may signal potential financial risk if the trend persists. 2021 remained the stronger, providing the company with a substantial liquidity cushion of 2.78 times. This is followed by 2022 with a ratio of 1.92 times, still indicating a comfortable position to manage its current liabilities. However, in 2023, the ratio dropped to 1.68, showing a weakening liquidity position and raising concern about the company's ability to manage short-term liquidation as efficiently as before. For net working capital, the current asset minus current liability, which is in 2021, the company had 167,051 in net working capital, representing a stronger liquidity position. In 2022, NWC decreased to 1,317,667, still more than sufficient to cover its short-term liability, but with a smaller margin. By 2023, the decline in NWC to 881044 indicate that the company liquidity position has weakened over time. Activity ratio. The ratio show an improvement from 4.94 in 2021 to 5.89 in 2022, which indicates the company had better management of credit and possibly a stronger cash flow position. However, there is a slight decrease to 5.71, still higher than in 2021, but this small decline might suggest a slight weakening in the efficiency of collection. Average collection period. In 2021, the data showed that the company receivable management was lower with an ACP of 73 days, which could indicate potential cash flow problem. However, in 2022, the company improved in collection effort, becoming more efficient and achieving better cash flow. In 2023, the ACP slightly increased to 63 days, suggesting a mild deterioration in the company receivable management. This could indicate issues such as low payment from customer, potential relation or of credit or difficulty the following in following up on collection. 2021, the data showed that the company receivable management was lower with an ACP of 73 days, which could indicate potential cash flow problem. However, in 2022, the company improved in collection effort, becoming more efficient and achieving better cash flow. In 2023, the ACP slightly increased to 63 days, suggesting a mild deterioration in the company receivable management. This could indicate issues such as low payment from customer, potential relation or of credit or difficulty the following in following up on collection. Average payment period for 3 years. In 2021, the average payment period was too short, which may indicate that the business was not benefiting from its supplier. Average payment period for 3 years. In 2021, the average payment period was too short, which may indicate that the business was not benefiting from its supplier. Longer payment term. In 2022, extended payment term became an effective strategy for companies to generate and preserve working capital and cash flow. Meanwhile, in 2023, the company was strategic in managing its cash by delaying payment without damage.
Inventory turnover. In 2021, the inventory turnover ratio was relatively high at 12.18 times, indicating that the company was able to sell inventory quickly and manage stock efficiently. However, in 2022, the ratio dropped to 8.12 times, which could be warning sign of inefficiency or a market slowdown, suggesting that the company need to hold on to unsold stock for a longer period. Fortunately, in 2023, the inventory turnover ratio rebounded to 11.49 times, indicating a strong recovery in sale and a regained momentum in inventory management. Total asset turnover. Trend analysis showed that both 2021 and 2022 had the same total asset turnover, representing the best performance in the last 3 years, even though the company was not proactive in improving its asset turnover. In 2023, with a ratio of 0.35 times, it was the worst year, showing a decline, despite to potential inefficiencies in how the company is using its asset to generate revenue. Fixed asset turnover. In 2022, fixed asset turnover ratio increased to 0.67 times, showing an improvement from the previous year of 0.66 times. However, 2023 marked a decline, with the ratio dropping to 0.59 times. This decrease over the past 2 years signal that the company became less efficient in utilizing its fixed asset to generate revenue, which may indicate challenge in maintaining the same level of asset efficiency. Debt ratio measure the proportion of a company total asset that is defined by debt. Between 2021 and 2022, the small increase is almost negligible, but it showed that the company slightly increased the reliance on debt from 39.57 to 39.61. However, in 2023, the debt ratio showed positive trend with a decrease of more than 3%, as a lower debt ratio of 36.56 typically indicate that the company is becoming less reliant on debt to finance its asset. This suggests improved financial stability and reduced leverage risk. Debt equity ratio measures the proportion of a company debt relative to its shareholder equity. As shown in 2022, the ratio was 65.60, indicating greater financial leverage and potentially higher financial risk compared to 2021, when the ratio was only 65.49. However, in 2023, the ratio decreased to 57.63, which suggests that the company performance is improving with a healthier balance between debt and equity. Time interest earned. Ratio measures a company's ability to cover its interest payment with its earning before interest and tax. Over the past 3 years, the best performance was in 2022, with a ratio of 8.17 times, significantly better than the previous year, which had a ratio of only 7.28 times. This indicates a greater ability to meet interest obligation and is generally viewed as a sign of financial strength. However, in 2023, the ratio dropped to 4.20 times, representing a significant deterioration. This suggests a notable increase in financial risk and leave the company with a less room for the error working its interest payment. Gross profit margin will show how efficiently a company produces and sells its goods, reflecting the percentage of revenue that exceeds the cost of goods sold. The change from 2021 with a gross profit margin of 31.02 to 2022 within 31.18 indicates that the company gross profit margin improved marginally and that its performance remained relatively stable. However, the situation in 2023 raises concern. A gross profit margin of 25.22 in 2023 suggests that the company may be facing challenges such as increased production costs, reduced demand, or competitive pressure, all of which could be eroding profitability. Net profit margin will show the percentage of revenue that remains as profit after all expenses have been subtracted. The analysis showed that from 2021 to 2022, the NPM slightly increased by 0.12 from 15.03 to 15.15%. This indicates effective cost management during that period. However, in 2023, this trend is considered negative as the NPM dropped to 8.96. This suggests that the company may be facing rising costs or decreasing efficiency in converting revenue into profit. Operating profit margin measures the percentage of revenue that remains after expenses on non-operating and offsetting costs such as tax and interest. The trend from 2021 to 2023 indicates a constant declining operating efficiency, especially in 2020 margin dropped from 5.27 to 3.7%, showing a continuous negative decline in profitability could generate financial strain, which financial strain to improve operational efficiency. Operating profit. Return on asset. Ratio measures how efficiently a company uses its asset to generate profit. The slightly increased from 5.37 in 2021 to 5.50 in 2022 indicates better efficiency in utilizing asset to produce profit. However, in 2023, the ROA dropped from 5.50 to 3.1, suggesting that either company profit have been falling sharply or its asset base has increased without a corresponding rise in net income. Return on equity. The return on equity ratio measures how efficiently a company uses shareholder equity to generate profit. The increase from 8.88% in 2021 to 9.10% in 2022 is relatively small but positive, suggesting that the company was somewhat more efficient at utilizing shareholder capital in 2022 compared to 2021. However, in 2023, the trend indicates a significant decline in ROE within a drop 4.89. The signal a need for the company to address its profitability issue and improve equity utilization.
Now let's move on to the comparative analysis between Genting Plantations, Berhad and Sarawak Oil Palms Berhad. Liquidity ratio, current ratio. Based on the comparative current ratio, SOPB demonstrates a better liquidity position and a larger margin of safety in meeting short-term obligation with a current ratio of 2.79. Meanwhile, GPB current ratio of 1.88 still indicate that it can cover its short-term liabilities. However, if faced with unexpected operational challenges, the company could face greater pressure and may struggle to manage liquidity efficiently. Quick ratio. The comparison indicates that SOPB is the stronger performer in terms of liquidity for 2023 with a quick ratio of 2.19. The company is managing its short-term assets and liabilities efficiently enough to cover potential disruption in cash flow. For GPB with a quick ratio of 1.68, the company is still in a reasonable liquidity position, but there are potential challenges in meeting short-term liabilities, especially net working capital. In 2023, Sarawak Oil Palms Berhad has a net working capital of 1,637,451,000 ringgit, placing the company in a more secure financial position to handle unforeseen financial stress or operational disruption. Genting Plantations Berhad with a net working capital of 881,044,000 ringgit can still meet its short-term obligation as its net working capital is a positive and current asset exceed current liabilities. However, the company needs to be more cautious in managing working capital in the future. Activity ratio, account receivable turnover. SOPB performance seemed more optimal, showing a much higher account receivable turnover of 90.14 times. This signals the company greater efficiency in quality receivable. Meanwhile, GPB with a ratio of 5.71 times is performing moderately well. If GPB does not improve their account receivable turnover, it could lead to cash flow challenges and potentially higher exposure to bad debts. The comparative average collection period indicates the SOPB takes an average of only 90 days per year to convert sale into cash, which is generally positive from financial perspective, especially for short-term operation and cash flow needs. In contrast, GPB with a relatively long SCP of around 60 days suggests that the company may face challenges in efficiently managing receivable and could have higher risk of bad debt. Average payment period. GPB takes a longer payment period of 78 days to hold on to its cash longer, which can be useful for improving liquidity or funding other aspects of the business. In contrast, SOPB uses a shorter payment period of around 23 days, which could pressure liquidity, especially during periods of lower sales or operational disruption. The company might not be utilizing its full working capital potential if it is paying out inventory turnover. From the comparative data, GPB has an inventory turnover ratio of 11.49 times, suggesting strong operational efficiency and a faster conversion of inventory into cash. In contrast, SOPB has a lower ratio of 8.07 times, indicating slower sale, less efficient inventory management, or higher level of unsold stock compared to GPB. Fixed asset to GPB. Fixed asset turnover. SOPB has a better fixed asset turnover ratio of 2.65 times, reflecting better asset utilization and a more efficient use of fixed asset to generate revenue. In contrast, GPB has a significantly lower cash of only 0.59 times, indicating that company is not utilizing its fixed asset efficiently, potentially leading to inefficient capital usage or underperformance relative to its asset base.
Total asset turnover. Sarawak Oil Palm Berhad with a total asset turnover of 0.98 times appear to perform better in terms of asset utilization compared to Genting Plantations Berhad, which has a total asset turnover of 0.35 times. The latter figure is relatively low and could indicate inefficiency in utilizing its asset to generate sale. It may suggest that company has inefficient investment, fixed or long-term assets that are not fully generate revenue. Leverage ratio, debt ratio. Genting Plantations Berhad has a debt ratio of 36.56% compared to Sarawak Oil Palm Berhad SOPB, which has a lower debt ratio of 29.56%. The higher debt ratio of GPB could imply greater financial risk, making it more vulnerable to interest rate inflation and financial difficulties during economic downturns. Meanwhile, SOP lower ratio typically suggests a more conservative capital structure with a larger proportion of financing coming from equity, which could provide more stability, especially in time of economic uncertainty. Gross profit margin. From this comparative analysis, GPB appears relatively efficiency at managing its production costs within a GPM of 25.22%. In contrast, SOPB GPM of 14.53 indicates that the company faces more pressure in managing its cost of goods sold, which may make it difficult to absorb non-operating expenses or fluctuation in input costs. Net profit margin. GPB net profit margin of 8.96 suggests a solid ability to turn revenue into profit, indicating that the company is effectively managing both its core operational costs and non-operating expenses. In contrast, SOPB with a net profit margin of 6.14 is a weaker perform in terms of profitability, suggesting it faces higher expenses or challenges in converting revenue into profit. Operating profit margin. GPB has a higher operating profit margin of 15.11%, which shows that the company has strong operational control and that its core business is highly profitable. In contrast, SOPB lowest margin of 7.89% suggests that the company may have less pricing power or high operational inefficiency. Return on asset. 6.03 ROA for SOPB is significantly higher than GPB, indicating that Sarawak Oil Palm Berhad is much more efficient and generating profit from its asset, reflecting efficiently capital allocation and higher productivity. In contrast, GPB is earning a smaller return on its investment in asset, which could be due to high asset level that are not generating enough profit relative to their size. Return on equity. An ROA of 4.89% for Genting Plantation could suggest that the company is either not very efficient in utilizing its equity or that its profit are relatively low compared to the equity invested in the business. In contrast, SOPB with an ROE of 8.56% is more efficient in utilizing its shareholder equity to generate profit. This higher ROE is a positive indicator for investors as it suggests better profitability and more effective capital utilization.
While, although Genting Plantations Berhad is weaker overall in terms of activity efficiency and leverage, the company has higher profitability margin and better return on asset and equity from its core operation, suggesting it could provide better returns to investors in terms of profit. Although Genting Plantations Berhad is more profitability and generate higher return on asset and equity, Sarawak Oil Palm Berhad is a safer and more stable option for long-term investors who prioritize capital preservation, growth potential, and financial stability. The company is better positioned to manage the risk while offering growth, which is crucial for long-term investment success.